We have already seen this example, NSE 100 daily chart, and as of the last bar, you can see prices were in downtrend. The previous day gapped down and traded lower, confirming the bearish momentum, and last day of this downtrend, prices gapped below its previous day, adding more to the bearish momentum. But still, prices closed well above their open price. The close was even above the midpoint of its previous negative bar day, suggesting us that something is wrong with this current downside momentum. Well, let's go ahead and add some bars and see what happens next. Next day, prices gap above its close price and trade higher. It even closes above its own open price, adding to the fact that prices have reversed their direction and prices tend to trade higher unless there we see a dark cloud cover again. So dark cloud cover and piercing line pattern are strong reversal patterns, but both of these reversal patterns are only useful when market is in either overbought or oversold condition, when market is ripe to change its direction. Hence, candlestick, every pattern found in candlestick analysis needs to be used along with other technical indicators. Simple indicators which will help us understand the stage of market trend. For example, let's say this dark cloud cover and this piercing line pattern, they both are successful pattern. Now, is there a way how we could understand that market was ripe to change its direction? For these pattern to be successful, market was in its own way ready to change its direction. Is there a way how we could understand this? One of the ways how we could see if market is ripe to change its direction is to use some of overbought and oversold oscillators. There are many oscillators found, but conventional oscillators like stochastic, MACD, CCI, commodity channel index, and RSI could be used to understand the stage of current market trend. So I will add stochastic oscillator with its default setting, stochastic %D. I'll add, color will be black, and if you are aware, have used previously stochastic, you will know that 80% and 20% are the level where one must be aware that market might change their direction from these levels. So every time stochastic %D reaches either 80 or 20, these levels are called overbought or oversold levels. So a stochastic %D reading of above 80 is overbought. Stochastic %D reading of below 20 is oversold. So I could use an oscillator to help refine these reversal patterns. We will talk more about this in later section, but I just gave an idea of how candlestick patterns could be used with simple momentum oscillators to find effective reversal patterns. So let's once again revise piercing line pattern. This is opposite of dark cloud cover. Scenario is similar to dark cloud cover, just that prices are trending lower, downtrend is in place. First candlestick is a long dark candle which solidifies traders' belief that downtrend continues. Next day prices gap lower below its low price, clearly telling us that market is more bearish than it was yesterday. But For the trading day, prices trade higher. In fact, they close above the midpoint of previous day's trading range, offering a significant change to the downtrend mentality, and thus most traders will bite the bait and reverse their position or exit the market.